Good afternoon and welcome to the US Solar Fund PLC investor presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Tom O'Shaughnessy. Good afternoon to you, sir.
Thank you, and welcome to the results presentation for the US Solar Fund PLC for the 6 months ending 30th of June 2024. My name is Tom O'Shaughnessy, and I'm the head of North America for Amber Infrastructure. Amber Infrastructure Investment Advisor, LLC, is the appointed manager of the US Solar Fund. Now, you'll hear me refer to the US Solar Fund throughout this presentation using the abbreviation USF, and Amber Infrastructure Investment Advisor, LLC, as Amber. The format of today's presentation will involve me providing a summary of the key information related to the financial and operating performance of USF for the first half of 2024. I'll then provide additional detail on specific topics, and finally, we'll answer questions submitted through the chat function. Just for context and orientation for anyone who didn't see the annual results presentation, Amber took over the role of investment manager in December 2023. We were selected through a competitive process by the board to act as the investment manager following a strategic review undertaken by the company. Amber's role as the manager of USF includes, firstly, ensuring that the reporting and other information provided to the market is delivered to a high standard. Secondly, proactively managing the assets within the USF portfolio and proactively managing the balance sheet of the company. And thirdly, to present the board and shareholders with options and recommendations aimed at improving shareholder value. As of the date of these results, we've now had 7 months as the investment manager, and during this time, we've been able to enact, under the board's guidance and instruction, improvements to the reporting and operating performance. I will highlight changes that have been implemented throughout this presentation. Again, for context and as set out in the chair's statement, it is a clear objective of the investment manager and the board to seek to liquidate the fund as market conditions improve. I will now talk to the financial and operating performance of USF for the 6-month period ending 30th of June 2024. Over the period, net asset value per share reduced approximately 4% from 78 cents a share in December 2023 to 75 cents a share in June 2024. Overall, NAV reduced from 258.2 million to 230.4 million, a reduction of just under 11%. The reduction in net asset value primarily resulted from the tender offer completed in June, which returned $18.6 million to shareholders, and due to the increase in the discount rate used to value the fund from 8.8% in December to 9.2% in June. During the period, and separate to the tender offer, dividends were paid of $6.8 million. On this topic, and specific to the information shown in the summary slide, I'd note that the dividend coverage presented here is on a rolling 12-monthly basis. This is not therefore indicative of the level of dividend coverage expected for the full year 2024, based on the revised target dividend level announced at the time of the 2023 full year results. From an IFRS perspective, the company generated a $2 million loss during the period. And during the period, the stock continued to trade at a significant discount to the net asset value. The market capitalization of the fund on the 30th of June was $147.8 million, representing a circa 42% discount to the March net asset value of $255.9 million and a 36% discount to the newly published net asset value of $230.4 million. The weighted average length of contracted offtake agreement fell during the period from 11.9 years to 11.4 years, as would be expected given the passage of time and the fact that no new contracts were entered into during the period. Leverage at the 30th of June was around 39% of total gross asset value, well below the 50% maximum gearing allowable. The revolving credit facility was undrawn and has been reduced during the period to reduce the holding company level costs incurred by the fund. Now, during the period, we've been able to advance plans to refinance the existing debt of the company and expect to be in a position to propose options to the board in the near term in line with our previously announced schedule. Finally, towards the end of this presentation, Dan Watson, our Head of Sustainable Investment, will touch on some of the key environmental highlights. Now, going into more detail around the net asset value movements. I'll use the net asset value slide as our agenda for the first section of this presentation, highlighting the key reasons for net asset value movements and providing additional information for each. As stated at the outset, overall net asset value was reduced in the period from $258.2 million to $230.4 million. The reduction in NAV is a result of a number of factors, and I'll walk through each of these to describe each change in greater detail. As stated, the main driver of the reduction was the tender offer completed in June 2024. This reduced NAV by $18.9 million. Information related to the final results of the tender offer was circulated on the 11th of June 2024, and capital was returned to shareholders at a small discount to the December NAV. Dividends were paid during the period of $6.8 million. The payment of dividends is shown as a reduction to NAV due to the presentation format we're using here, which aligns with the industry peers. This corresponding entry of cash received during the year to date is included in the NAV return bar. Talking to discount rates, the increase in the discount rate applied in the calculation of net asset value reduced the June NAV by $8.6 million compared to December 2023. The increase in the overall discount rate to 9.2% from 8.8% at the prior year end was almost entirely a result of changes in the underlying risk-free rate used in the calculation of the discount rate. We use the 20-year US Treasury rate as a proxy for the risk-free rate, and that increased by around 40 basis points between December 2023 and June 2024. It has subsequently reduced. During the period, Amber concluded a review of the forecast operating and financial assumptions of the company. The company has needed to amend a number of the assumptions as a result of concluding that review. The largest change relates to the determination that certain contracts entered into in November 2023 to sell renewable energy certificates in relation to 6 of USF's Oregon projects required termination. We made the decision to publish a separate RNS related to this issue at the same time as these interim results. This is in order to provide more details to the market. And as explained in that RNS, renewable energy certificates are tradable certificates awarded to generators of renewable energy to incentivize production. These can be sold along with or separate to the electricity generated. The Oregon renewable energy certificate contracts were entered into in November 2023 under authority delegated to the company's previous investment manager in line with the investment management agreement. The terms of those contracts would have been cash flow accretive to the company. Amber and our legal advisors' review found that these contracts needed to be terminated. The impact of terminating these Oregon renewable energy certificate contracts are reflected in the company's 30th of June 2024 reporting and include an approximately $8 million negative adjustment to net asset value, which was equivalent to the increase in net asset value included at the time of signing these contracts in 2023. It also includes certain costs related to the termination of these contracts. A termination payment was due based on the replacement cost to the buyer of the renewable energy certificates. And that's the difference between the cost of the Oregon solar renewable energy certificates at the time that the contracts were entered into in November 2023 and the cost of the Oregon solar renewable energy certificates at the date the contracts were terminated, September 2024. Now, this type of payment is typical for termination of these types of contracts, and again, I reiterate, it's fully included in the June net asset value. And as such, this matter is now fully resolved, and the impact on the valuation of the termination and costs is fully reflected in this June NAV. In terms of next steps, a detailed review is being conducted by USF's retained legal counsel, and the company will consider all remedies available to it to recover any losses associated with the termination of these Oregon renewable energy certificate contracts. Any recovery would enhance the net asset value in future periods compared to the positions shown in this June net asset value. Finally, Linking this back to the NAV bridge chart on the first slide, as part of the investment manager's review, in addition to the above mentioned updates to cash flow assumptions related to these renewable energy certificates, revisions have also been deemed necessary to the operating assumptions on some other contracts. These have resulted in a small or 0.4 million gain to net asset value, resulting in the net impact of changes in operating assumptions of 7.6 million. Now, I'll quickly touch on changes to the macroeconomic assumptions. Changes to the macroeconomic assumptions in this period were very small. Changes included small adjustments to the deposit rates and inflation assumptions that we use over the near term. The total impact of these changes totaled $0.4 million. I'll take this opportunity to remind everyone that this portfolio is around 88% contracted for the next 10 years through fixed nominal power purchase agreements. These agreements do not adjust for inflation, and hence high inflationary environments, like those experienced over 2022 and 2023, have a detrimental impact on operating cash cover. I'll make a quick note on changes to energy prices. Forecasts of future energy prices have increased during the period. This has had a positive impact of $11.6 million on the net asset value due to the additional cash flows forecast to be received as a result of these higher prices. The increase in energy price forecasts are a result of a variety of factors affecting the region in which USF owns assets. During the period, we released on our website a white paper discussing some of our views on energy price movements. Touching now on additional disclosures made in this set of results. Based upon our review of the materials previously presented to the market, a comparison of the information provided relating to USF, and also based on feedback received from shareholders, we've provided additional information in the interim report in a number of areas, and I'll highlight a few of these here. Firstly, we've provided additional information related to tax equity. We noted a general gap in some shareholders' understanding of the role of tax equity and its impact upon the cash flows of the company. As a result, we've provided additional information related to the ongoing forecasts of the cash flows to be paid to tax equity providers across the USF portfolio over the next 4 years. I'd reiterate the final point on this slide, that these payments have been included in all prior year forecasts related to the company. They had not, however, to date been specifically disclosed, and therefore, whilst this is new information, there is no impact or change in the current period related to tax equity and its impact on the portfolio. Secondly, in terms of disclosures, we've sought to improve the trend analysis related to the operational performance of the portfolio. In prior years, period-to-period weather adjustment and non-weather adjusted performance had been presented, but an analysis quantifying the average deviation from the forecast weather-related performance had not been provided, and this has now been rectified. The chart shown on slide 13 shows the weather-related performance versus forecasts in each period starting in 2020. This allows for a comparison of the forecast for generation to the observed generation in each period, as well as the average deviation of the portfolio from these forecasts. Finally, we have also released, as we did for the last quarter, an Excel spreadsheet which provides supporting information for the charts on contracted revenue, tax equity, debt amortization, and projected cash flows. Turning now to operational performance. Now, slides 15 and 16 provide some additional details on the portfolio and key metrics for reference as we talk to operational performance. Now, I'd note that the portfolio includes geographically assets in North Carolina, and I'd just like to remind all listeners that the USF portfolio does not include assets on the west side of North Carolina, and that is particularly relevant to the events of last week and these storms and the impact of storms that came through Florida, North and South Carolina last week. I'll immediately return to talking about weather-related portfolio performance during the first half of 2024, in addition to the additional disclosures that I mentioned before. So the portfolio performance generally remained within reasonable parameters for over or underperformance during the period. The total performance of the portfolio was 6.8% below forecasts, and that was an improvement on 2023. Variance in performance can result from two sources: weather variance versus forecasts and underlying asset performance, which includes outages and unscheduled maintenance. During the first 6 months of 2024, the portfolio performance due to weather was 3.2% below budget. This was almost entirely attributable to the first quarter. The second quarter, for reference, saw weather-related performance exactly in line with forecasts. The Milford Solar Project in Utah was a significant contributor to the weather-related underperformance due to an exceptionally wet February and March in the county in which the asset is located. Turning to non-weather-related underperformance, non-weather-related underperformance was 3.6% below forecast for the period. This underperformance was attributable to the Heelstone, Olympus, and Granite portfolios, where low-level inverter outages, grid outages, and some communication issues impacted generation. During the period, we replaced the O&M contractor in relation to the company's 2 California assets based on a performance review carried out during Q1 of this year. This was the first step in a phased replacement of existing O&M contractors on other assets, which will be implemented over the next few months. We have seen the performance of the Californian assets improve following replacement of the O&M contractors. We don't expect to see any additional costs as a consequence of making these replacements. Our internal asset management processes and procedures are allowing us to capture and address problems across the portfolio more quickly and deal with them more efficiently. This is the major area of work for us, as the portfolio has exhibited, as I said, a large number of smaller issues rather than a concentrated number of larger issues, having dealt with those as part of our activities over the first couple of quarters of this year. Since appointment, Amber's team has been out on site visiting the assets. The remaining issues are being worked through on a systematic basis and in accordance with Amber's own asset management procedures. To date, we've been able to advance our review of contractor performance in order to identify opportunities for improvement in that performance, including replacement of certain subcontractors. We've been able to improve facility operations and data capturing through advanced analytics, including a digital control software pilot. This pilot program for operations and data collection is being trialed at the 2 Californian sites and allows us to operate certain aspects of the operations remotely. If successful, this would be rolled out to the other sites within the broader portfolio. We've also been able to continue to proactively identify the system health issues contributing to underperformance of the facility. This work's mainly undertaken through utilization of aerial drone scans and advanced data analytics. We've been continuing to work with key subcontractors and technical advisors to improve spare parts management, which is critical to the ongoing performance and preventative maintenance plans for the assets. And as set out in the annual results, we've initiated and continued a preliminary assessment of site repowering opportunities at certain older sites within the company's portfolio. Turning to sustainability issues, I'll pass this now to Dan Watson, our Head of Sustainability, to provide an overview of the key sustainability aspects of 2024 so far and the next steps.
Great, thanks Tom, and it's a pleasure to speak with you today, and we're pleased to provide an update on the company's progress in relation to sustainability. The company's investments in solar power continue to play a crucial role in generating clean energy, reducing greenhouse gas emissions and supporting the global shift to a low-carbon economy. One of our key achievements during the first half of 2024 was the release of our 2023 Sustainability Report, which featured important updates on key regulatory frameworks, including the Task Force on Climate-Related Financial Disclosures, the EU Sustainable Finance Disclosure Regulation, and the EU Taxonomy. These updates help ensure that our efforts in sustainability are transparent and aligned with best practice across the industry. Internally, we've updated our disclosure processes to align with the UK's sustainability disclosure requirements, incorporating new processes to ensure alignment with the anti-greenwashing rules. This shift has strengthened the integrity of our sustainability reporting, ensuring that we remain accountable to our stakeholders. We've also been engaging closely with our third-party asset managers and operations teams to enhance the quality and consistency of data collection, which is crucial for measuring our impact accurately. Looking ahead to the second half of 2024, we are exploring the possibility of classifying as an SFDR Article 9 financial product. We're also planning to consult with the company's shareholders to better understand their views on sustainability labelling under the UK sustainability disclosure requirements. Additionally, we'll continue to explore climate risk by incorporating scenario analysis to further align with TCFD guidelines. Of course, economic benefit will sit at the heart of any decision-making in relation to standards and benchmarks. Now, turning to some key performance highlights for the first half of the year, we're pleased to report that our 41 operational solar assets with a total capacity of 443 megawatts have generated 365 gigawatt hours of electricity. Now, this is enough to power approximately 37,000 homes in the United States. By producing this clean energy, the company has effectively removed the equivalent of over 55,800 cars from the road and avoided more than 234,500 tonnes of CO2 emissions. These results underscore the tangible environmental impact of the company's investments and the important role that they are playing in driving the transition within the US. I'll now hand back to Tom to conclude the presentation.
Thank you, Dan. Finally, I'll turn to the outlook for the assets and changes to state and federal policy in the US. For an operational solar portfolio such as USF's, the relevance of state-level policy often outweighs the broader US federal agenda. This is especially true in light of the continued position that USF will not be making new investments at this time. The growth in the pipeline of available new acquisition opportunities and factors that impact new projects is therefore less relevant in these circumstances, and are therefore focused here on features of the market relevant to operational solar portfolios. We're continuing to see demand drivers for renewable energy increase in the US. In our view, one of the biggest factors impacting demand currently is the growth in artificial intelligence, computing, and the corporate responsibility objectives of companies focused on artificial intelligence. This is leading to increased demand for renewable electricity. State policy objectives continue to increase, and again, we've recently issued a white paper explaining some of the trends that we are seeing in the key markets relevant to assets within the USF portfolio. Along with these demand drivers, we're continuing to observe significant challenges in the deployment of new renewables. Most significantly, the congestion in the interconnection queues for renewable energy to be connected to the grid still create problems in many areas. Generally speaking, this position is deteriorating, and available grid connections are becoming more valuable as new connections are harder to obtain. We expect this to likely get worse before it gets better. And overall, the impact is that the demand for renewable electricity is believed to outstrip supply in the short to medium term, potentially benefiting existing owners of renewable generation. Challenges to this view include any willingness by states or corporates to reduce their renewable energy objectives and embrace fossil fuel electricity generation, for example, within their plans as their demand increases. Finally, a note on the US election. Specific to renewable energy, the Republican candidate for the US election on November the 5th has threatened to review certain aspects of the Inflation Reduction Act passed under the current administration. Any changes to the IRA would not directly impact the USF portfolio, as there are no revenues or benefits assumed within any of the portfolio assets that are linked to the future of the Inflation Reduction Act. An initiative to enhance or support fossil fuel generation would not necessarily impact the state or corporate renewable energy objectives in the US market, which is independent of more general power prices. A move by a Democratic administration to enhance or encourage renewable generation could potentially, over time, increase or help the supply of new renewable electricity, which could in turn potentially reduce renewable energy power prices. However, we are not currently aware of any specific initiative to further stimulate the renewable energy sector over and above the Inflation Reduction Act and other existing associated legislation at this time. With all that said, I'll lastly provide a reminder of the fixed contracted elements of the USF portfolio. Over the next 3 to 9 years, the North Carolina assets are fully contracted under fixed nominal contracts. These contracts have a weighted average remaining life of 7.3 years. North Carolina has a clean energy mandate for a fully carbon neutral electric supply system by 2050, with an interim target of a 70% reduction in carbon emissions by 2030. Similarly, Duke Energy has a corporate clean energy objective goal of net zero electricity by 2050, with an interim target of 50% reduction in carbon emissions from 2005 levels within its network by 2030. Overall, North Carolina and its major utility, Duke Energy, are committed to clean energy. In Oregon, fixed price nominal contracts are in place until 2031 across the USF portfolio. And in Oregon, the Western Energy Coordinating Council is driven by state targets, and the key themes are retirement of gas and availability of hydro generation. Oregon has mandated that at least 50% of its electricity should come from renewables by 2040, with an additional target of reducing greenhouse gas emissions by 95% by 2050. Again, Oregon is very committed to procuring energy from renewable sources. For Milford, the Utah asset, a fixed price nominal contract will be in place until 2045. For Utah, or through the resident utility's own commitments to renewables, as in the case of Pacific Corp subsidiary Rocky Mountain Power, the outlook is for increased demand for solar. Pacific Corp has a corporate clean energy target of 74% reduction in carbon emissions, again from 2005 levels, across its network by 2030. In California, the fixed price contracts for this portfolio remain in place until 2036. California has a very aggressive state-level renewable energy mandate, with 60% of its electricity mandated to come from renewables by 2030 and 100% greenhouse gas-free electricity supply system by 2045. Now, with those reminders completed, that concludes the presentation. Thank you all very much for your time, and we'll move on to answer questions submitted through the Q&A.
Tom, Daniel, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions. You can do that just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to read the questions that are being submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions throughout today's presentation. And Meredith, at this point, if I could hand over to you to chair the Q&A, that'd be great. And then I'll pick up from you at the end.
Thanks very much. Tom, many of these questions are for you, so I'll direct them to you. What steps are being taken to optimize the portfolio, and particularly the Milford site, given that's the largest asset?
Our optimization procedure for these types of portfolio is pretty standard. Firstly, we create diagnostic plans to understand where there are issues. Secondly, we create a remediation plan to clearly explain and cost how we will improve the performance. And finally, we move into a preventative maintenance plan where we use the allocated maintenance downtime that each of the assets have scheduled into their forecasts to put preventative measures in place that stop outages and unscheduled maintenance in the future. What we've been able to do over the last 6 months is complete that diagnostic plan and start working through the remediation plan. Our goal by the end of this year is to have the remediation plan fully fleshed out and to be continuing to work through that on a prioritization basis where we deal with the most significant issues first. Our objective is to then move into a preventative maintenance plan, and we hope as a result of all of those, we see the operational performance of the assets improve and we're able to report in line with those improvements.
Thanks, Tom. And a related question is, should we expect further costs in relation to the REX termination payment? But are any other issues like the REX expected to happen again, or future issues that we anticipate in the USF portfolio?
So shareholders should not expect any additional costs in relation to the renewable energy certificate issue that was identified during this 6-month period. We've worked hard to include full and final settlement of that issue within the June 2024 NAV. One one of the outcomes of identifying this issue was that the team here at Amber have undertaken additional work reviewing some of the historic advice provided to the fund under the management of the prior manager, and reviewing that advice and the assumptions that were made on the basis of that advice. We're therefore, to the best of our ability, able to confirm that at this point we do not see any similar issues or related issues or issues that would impact the NAV negatively as a result of historic decisions taken over and above what's reflected here in this set of results.
Thank you. And I know you touched on this a little earlier, but could you expand on the upcoming US election and what the impact might be on the fund's portfolio, please?
Happy to. I think I'll talk maybe in the first instance about the white paper that we issued earlier this year. We are more focused on state level agendas driving the demand for renewable energy than we are on the federal agenda. We don't necessarily see the federal agenda impacting state level demand. We've seen many states strengthen their renewable objectives and their demand for renewable electrons throughout the last 8 years under different administrations, and they are committed in the majority of cases to go their own way and plough their own furrow in terms of their state level renewable objectives, as are corporates that are active in those states, and that's particularly relevant to people like Google and Microsoft, who are procuring energy for artificial intelligence applications and data centers, which is maybe the newest development in terms of demand that we've seen impact the market over the last 6 months. Where we see the federal agenda impacting assets like USF is indirectly through the facilitation of new supply coming onto the grid. Whilst the demand for renewable electrons remains strong, there is quite considerable volatility in terms of the forecasts around how much new supply, how many new projects generating renewable electrons will come online over the next 3, 5, 10, 20 years. And as federal agendas change and potentially additional headwinds are created through anti-renewable policies or removal of pro-renewables policies that were put in place under the current administration, that would only really serve, in our view, to create additional challenges to meeting those forecasts that have been made about new electrons coming onto the grid. It's a fairly basic sort of extrapolation of that we believe if there are additional headwinds created through the election and the change and any change of administration, that the demand supply imbalance might become greater, and that would lead to power prices and renewable power prices specifically increasing, which would be a benefit to existing operating generation assets such as those owned by USF. Conversely, if we saw a continuation of the Democratic administration at a federal level, and there were solutions posed or additional legislation passed or enhancement of some of the packages that currently support renewable generation, then we might see more supply come on the grid than is currently forecast, and that would lead to maybe a reduction in renewable energy prices and power prices for those assets and for existing operational generation assets like those owned by USF.
Great, thank you. There's a few related questions here about the company continuing to trade at a discount to NAV, and if we have plans for the future of the company and its assets and respective timelines. I wondered if you could talk about that and also what the activity in the US renewables market has been like for the last year or so, please.
Happy to. And I guess as a headline, nothing has substantially changed from the position that we set out at the time of the annual results. We included within that presentation a timeline for the activities that we expected to undertake and a timeline related to our expectations around market conditions. So we are pretty much in line with that schedule. We are seeking to do a number of things. I've talked during this presentation and at the time of the annual results about getting the company into the best possible form that it can be in order to prepare for any future options that present themselves, either future liquidity events or other opportunities to enhance shareholder value. We very much believe that having full visibility, full transparency, very high quality, diligenceable materials for everything to do with the fund is a huge benefit when considering any options that present themselves going forward. And that's really our job for this year, is to create those high quality materials and provide all the information that that can subsequently be presented to the market or anyone interested in the fund. The second thing that we've been doing, which is related but slightly separate, is optimizing the balance sheet of the company. We talked during the annual results about the opportunity that may exist to create a more appropriate capital structure for the company. And again, we've been able to progress that in line with the schedule that we set out earlier in the year. In terms of the market and the market conditions for any future liquidity event, we have seen over the last 6 months new entrants into the US solar space. Our view is that macro conditions are maybe more predictable now than they were 12 or 18 months ago, and that presents an opportunity for some parties, new entrants into the market, to take a view on the macro and where the macro situation might be over the next 12 months and seek to create value by coming into the market and acquiring solar and other renewable assets. We have, I think we're encouraged by that. We see that as a trend that ends with the market returning to maybe closer to the levels and the pricing and terms that we saw for the trading of renewable assets that we did in 2022 and 2021. But for right now, we don't see that market and the volume of transactions that we're seeing in the space as the right market to launch a sales process or any type of process around the fund. We, I guess, continue to monitor the market. The board are very actively working to put pressure on us as the investment manager to communicate well with them around any transactions we see which are similar to a sale of a portfolio like USF, and just use those as data points to guide future decisions made about the fund and any future liquidity events. We'll continue to do that if we continue to see the macro environment improve and we are right in our assumption that the new entrants to the market are indicative of a return to the types of trading environment that we saw in 2021 and 2022, then I think we will work with the board to assess our options during 2025.
Great. And the final question here is, do we have mitigants in place for any future periods of high inflation that might impair the financial performance of the portfolio, but B, any severe weather events that could impact the assets themselves?
So as it relates to inflation, no. It's difficult, if not impossible, to hedge ourselves against the impact of future inflation, both from a real returns perspective, but also from an operating cost perspective. The real impact for us of a high inflationary environment comes from those fixed nominal contracts, which are very typical of the US market, but do expose investors seeking real returns to inflation risk. From an operating cost perspective, we'll always seek to lock in as long a contract as possible and try and push some of the risk of inflation to subcontractors or to parties that are potentially able to take a view on that risk. But that isn't necessarily typical of the market, and where we have costs that fluctuate in line with the market, such as insurance, it is very difficult to hedge against that. Hence, we will continue to present inflation and high inflationary environments as a risk, certainly to short-term cash flows. Now, I'll add to that the nuance that whilst inflation is a risk to short-term cash flows because of those fixed nominal contracts, overall inflation is a benefit to the net asset value of the portfolio, and that is because inflation impacts the future assumptions about energy prices. And once those fixed nominal contracts have run off, you do see higher prices paid for the electricity under high inflation environments. So our caution, and as again, I reiterate, we're going to continue to caution the market and shareholders and the analyst community around this, is that high inflationary environments for this portfolio negatively impact operational cash flows, but positively impact the overall NAV of the fund.
Okay, perfect. If I could just jump in there, and thank you for answering the questions from investors. Of course, the company can review all the questions submitted today, and we will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which is particularly important to the company, Tom, could I just ask you for a few closing comments?
Thank you very much for the time today. We're very much looking forward to continuing to stabilise the company post the issuance of these results. Thank you.
Tom, Daniel, Meredith, thank you once again for updating investors today. Could I please ask investors not to close the session, as you now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of US Solar Fund PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.